Today, I'm going to speak just a little bit on monetary history with reference to what's happening now, because it's necessary in understanding that the current potential trade and economic realignment could be one of the most significant economic events in our lifetime. This is not an overstatement. We're living through history in the making. This is commentary and analysis. Please speak to a financial advisor to determine what's right for you. If you don't have someone you trust, please reach out. The classic gold standard ended in the early 19th century. For the purposes of this discussion, the important thing to note is that the ability for a country to expand credit in the economy was restrained by the amount of gold the country held. When a country ran a trade deficit, they paid for that deficit in gold. As gold left the economy, it would restrain credit growth. Let's call this system the global gold standard. In 1944, after World War II, representatives from 44 countries met in the little town of Bretton Woods, New Hampshire, and agreed to alter the system. Rather than tying their currencies to gold, it was decided that the US dollar would maintain a gold peg and all other countries would peg their currencies to the US dollar. Therefore, any trade imbalances would be settled in US dollars as a representation for that underlying gold that backed the dollar. As part of this arrangement, to keep everyone honest, and by everyone I mean the United States, foreign central banks and governments could exchange their dollars for gold at the US dollar pegged price. This is what's referred to as the Bretton Woods system. Over thousands of years, similar currency schemes have always ended the same way, with the amount of paper currency receipts, if you will, vastly exceeding its reserves that back it. I try not to say always, but in this case, it's proper. Every single time, more paper currency receipts were created than were justified until the peg ultimately broke. The Bretton Woods system began to show signs of strain in the 1960s, when the US was running a large current account deficit. In the mid-1960s, other countries correctly suspected that the quantity of US dollars vastly exceeded its gold backing, and in response, some countries, most prominently France, started to exchange US dollars for gold, something they had the right to do, but until then was rarely done. In response to this, on August 15, 1971, Nixon announced that temporarily the US would no longer exchange dollars for gold. We're still waiting for this temporary order to be reversed, but I wouldn't hold your breath. That was arguably the end of the Bretton Woods system. However, the world would continue to use US dollars as a reserve currency, just as they did when the dollar was exchangeable for gold. Okay, so that's 50 years ago. What does that have to do with now? My Economics 101 class extolled the virtues of free trade. Each country should produce the items where they have a comparative advantage, trade with each other, and then we're all better off. And this is true. Let's put aside that in real life, it's a bit more complicated, and in reality, most economies don't engage in pure free trade, and that includes the United States even before Trump, but I'm not going to talk today about the barriers to free trade. Today I want to focus on whether the system balances or not. If Americans buy lots of products from the Chinese can buy products that are produced by Americans, and therefore the trade balance should, or at least can, balance, just like it did with the gold standard. This is not what has happened. Instead, the Chinese, for example, instead of them buying American-made products to balance our trade, they bought our securities, our stocks and bonds. And the US ran a large and persistent trade deficit. Why did this happen? One argument is that it's because the dollar is the reserve currency, and therefore, since countries need to hold dollars in reserve to trade with each other all over the world, the dollar has been persistently overvalued. This helps Americans buy cheap products from overseas, but it has the effect of hollowing out our manufacturing base, because if the dollar is in fact overvalued, that makes the products we sell around the world too expensive. I doubt Donald Trump was deep into the theory of it. I suspect he just looked around and determined that our manufacturing base was falling behind. This dynamic is a feature or a bug, depending on your perspective, of a country having a reserve currency. We're talking about the US, but the last reserve currency before the dollar was the British pound, and arguably, it also developed an overvalued currency which hollowed out its domestic manufacturing base. There was a period in 2002, in the wake of the tech bust, when financial market observers started to worry that the US would fall into a deflationary malaise, as Japan had done for the previous decades after its 1980 peak. In response, Federal Reserve member Ben Bernanke, who would later become chairman, gave a speech called Deflation, Making Sure It Doesn't Happen Here. In that speech, he provided a number of creative and novel policy responses to deal with a potential deflation scare. And when we had that deflation scare in 2008, he rolled them out one by one. In 2008, no one who read his playbook from 2002 was surprised. I wonder if we're witnessing a similar event now, except this time, we're not talking about deflation. I'm talking about a paper written by Stephen Miran called A User's Guide to Restructuring the Global Trading System. And it bears your attention because Miran is Trump's nominee to chair the Council of Economic Advisors. Miran writes that the root of economic imbalance lies in persistent dollar overvaluation. That's the first part. The dollar is overvalued. And that prevents the balancing of international trade. It's true that if the dollar were much lower, the US would export more and import less, which would bring trade closer to balancing. However, unlike tariffs, simply weakening the dollar does not directly generate tax revenue. Miram argues that tariffs should be implemented first, which is happening now, and this will be US dollar positive for reasons I discussed in my last recording. He says that the administration should be much more cautious in implementing currency policy and should wait to make sure inflation is closer to its 2% target, which is lower than the current readings, and also suggests that a weak dollar policy could be implemented when there is a new, potentially more friendly Fed chair in place when Powell's term expires in the middle of 2026. I note that this also meshes well with the current inflation outlook. Inflation is currently higher than target, so a stable or stronger dollar should be favored to help reduce inflation. Therefore, Miram expects policy to be dollar positive first and dollar negative later. I can't stress enough that if the administration genuinely intends to balance trade, this will be one of the biggest global monetary transformations in our lifetime. If the dollar does get significantly weaker, real assets like precious metals and real estate would do well, and non-US investments would do well in dollar terms, all else equal, and of course, all else is never equal. Whether a weak dollar would be positive or negative for the US stock market is less clear and will depend on conditions as we get closer. This paper is well thought out, and whether you agree with the premise and policy implications is besides the point. This thinking, I believe, is very influential in the current administration and financial markets. Therefore, this is a playbook we will revisit in the future. I would encourage you to talk to a financial advisor to determine what's right for you, and if you don't have someone you trust, feel free to reach out to book a complimentary meeting. Thanks for listening.